live, and then I'll type it out.
Cool. It's like we're live. Oh,
We are live.
we are live. Hello, coming to you from New York and Vietnam, wherever you are around the world. Good morning, good afternoon, good night, maybe middle of the night for you if you woke up for this. We have a lot to talk about today. Airbnb earnings, Equitable Bank earnings. We will likely do a earnings walkthrough of a stock that we both have not looked at before, so we can all, as a chat and community, look through together. And before we jump into it, Daniel, what's going on in Asia? I can't tell if that's an elephant shirt or not. You had a good streak going there.
This is not an elephant shirt this time. It's going good, man. We're in Nha Trang, Vietnam right now. It is currently 9 p.m. We just got back from dinner. And yeah, man, it's nice. We went swimming in some waterfalls today, went hiking in the jungle. It's pretty sweet.
Nice. Sounds a little
Yeah.
bit different than my day in New York City, to say the least.
Yeah, it was a good day. All right,
Awesome.
I'm just sending out the message and letting people know that we're streaming right now, and then we can hop into Airbnb's earnings because you are an Airbnb shareholder. Would you say that you're the most bullish on Airbnb right now?
If we're just looking at their business and ignoring their stock price, I'm as bull as ever. Everything that I have thought about this company is starting to come through fruition. I listened to the entire earnings call, did a lot of research on the CEO. There are very few things that concern me about this business, although we will share notes on them. I did try to do my best to have some bear notes and bull notes. Also, for everyone joining, you may notice we are just live on the Stock Unlock channel today. We are consolidating it back to one. So there was some feedback we got around some confusion of two chats going on. So got it back into one place for you guys. And yeah, Daniel, I'll share my screen and just start going through it.
All right.
So for those of you who watch us every week, you know this is not the first time we are talking about Airbnb. This was actually brought up on our October 12th show. And I thought it would be a nice way to start off to re-highlight what Airbnb was predicting for this quarter. So this is coming from their last report. So just to be clear, this is 1 quarter ago. They predicted between 1.8 and 1.88 billion. This was also coming off of their biggest quarter of the year since Airbnb is a seasonal business. You can see that their revenue tends to spike after they report for the end of holiday travel and things like that. And then they go through a little bit of a lull in the winter. They beat their guidance. They got 1.9 billion of revenue. So this is just a nice look at what they did the last quarter. Revenue's up 24% relative to the quarter 1 year ago, 319 million of net income. They did have their first profitable year ever. So it was a really, really big year for Airbnb. They came out of COVID. The company almost died. They actually had to cut a lot of their workforce back in 2020. And a fun stat is they are down 5% headcount still from 2019 levels when they reported, but their revenue is up 75% from the same time. So the company's got a lot more efficient.
Yeah, so they've significantly increased efficiency.
Oh, yeah, which is incredibly exciting. The company is very specifically a cash flow machine. I will try to make this a little bit bigger, but most of their operating cash flow does turn into free cash flow when you ignore stock-based compensation, which we will talk about more too. And Daniel, I know that you love high cash flow businesses. What do you think of some of these numbers coming out of Airbnb right here? If we're looking specifically at the 41% free cash flow margin.
I'm just going to make this full screen. Yeah, I mean, it looks like it costs them nothing to run this business in terms of CapEx. That's very nice. Revenue, free cash flow as a percent of revenue, that's their free cash flow margin is 41%. That's pretty dang good.
It is pretty high. One thing I like to look at companies as well, Daniel, is actually understanding the full business. And as a lot of our viewers know, I definitely have a heavy tech coding background. You'll be familiar with Stock Unlock, actually, the business we're building. The way that we're building the tech there is kind of the microservice architecture. Things are hosted on AWS. Basically, there's a lot of ways that you can implement your tech, and there's ways that you can do it through contractors and monolithic architectures that result in slow product development and a bricking of things over time. or there are newer ways of developing software and products that will allow you to be more nimble, more efficient with engineering spend, as well as have more agility when creating new features. Airbnb, as far as I can tell, looking at the engineers they have, their leadership are very, very great at making technology. And one of the reasons why they are executing so fast and building so many new features, as well as addressing customer concerns, because we can get into some of the pricing concerns there, as well as the cost per stay going up year over year and what they're doing about that. This company seems like very quick to move and are developing product at a very rapid pace. So I think part of what you're seeing in the margins here is also going back to what's happening internally. The way they're actually making this happen, in my mind, is very elegant, and the people working there are implementing things in a very robust way.
Yeah, they seem to be, well, like the founders, I believe, are all still at the company, and they seem to be.
Most of them.
Is it 2 out of 3?
Brian's still there. One of them I actually listened to an interview he did. I'm forgetting his name, but he left Airbnb to start some type of like modular home business that like Airbnb also invested in. So if they're not actually building Airbnb, they're literally building side economy businesses that like leverage and contribute to Airbnb's business. So I guess a little gray area, but
yeah. But yeah, they seem like a company that likes to innovate, get user feedback, and just like continue building and, building for their users, which is awesome. Like I do use Airbnb, and I see new features all the time.
Yeah. If anyone's curious about the interview I'm talking about, I'm sadly blanking out of the founder's name, but This Week in Startups is a podcast. Jason Calacanis is the host. It's honestly one of my favorite shows, and a few episodes back. Today's date is February 18th, 2023. So whenever you're watching this, within the past week from today, they put out an interview with one of the old co-founders of Airbnb. So it's an interesting one to watch. Anyways, keeping it close to this, Daniel, I know you and I go a little bit back and forth about Airbnb. We have fun with it. One comment you made in the past was the Airbnbs that you're renting out on your Asia trip have been subpar, and you have even considered canceling them for hotels. Very valid. One thing that I wanted to bring up was just understanding their revenue mix, which I actually thought was very interesting. So what we're looking at here is a breakdown of North America, EMEA. I had to look it up a few times, but it is Europe, the Middle East, and Africa. And then just to be clear, Asia Pacific is actually more than just China. It seems that it includes India, as well as parts of Russia and Australia, just to be clear what we're talking about here. So the percentage of nights booked has actually went down in America year over year, but it has went up in EMEA, which is interesting. However, that is not the same case for gross booking value and revenue. So gross booking value, GBV, is the total number of it's the total amount of cash, including fees, the amount that the hosts get. It's not just what Airbnb gets. It's just the little dollar amount going to hosts and everyone booked on the platform at once. Revenue is actually what Airbnb is getting back. So I think that this is one of the most important numbers to look at. Main point being here, Daniel, is pretty consistently around half of their revenue comes from North America, but it does look that they are seeing strong growth internationally. So this continues to be a worldwide business as they continue to scale out. And not to mention, China is just starting to open back up. So there was a lot of talk about that on their earnings call as well.
Yeah. I mean, I definitely see the growth drivers there around the world. We're gonna see what happens. I mean, I'm not the most optimistic on Airbnb, but so far I'm not seeing anything in the numbers that suggests, that my bear thesis is playing out at all.
I'm excited to talk about that because referencing back to the fact that they have 5% less headcount today than they did in 2019, but 75% more revenue, you can see that they are getting more efficient across the board year over year in terms of their margins. So they are spending less relatively for most of these line items, according to what they're making, which is great. A lot of the things I said on the earnings call was that urban stays are picking back up. Their average daily rate is pretty high. They see some headwinds towards that as they introduce more pricing features that will, they have their own economy there. So there will be some natural ebb and flow of, sellers are charging too much and then they start getting less bookings and then they lower their costs. Then consumers are happy because they're able to book more easily. There will be hairline margin differences for what Airbnb takes as that happens, but the share of their pie they expect, or as Brian, the CEO, said, will continue to grow. So even if their average daily rate ticks down slightly, their internal operating efficiencies, as well as just the total number of gross bookings and nights stayed they have, will continue to drive their overall revenue and net income numbers up. Yeah, Daniel, I'd love to hear some of your bear thoughts here. I mean, I have some of their guidance for the next quarter. Again, it's seasonal, so even though they did 1.9 billion this quarter, they are expecting a bit less, which is expected. And they always compare it to a quarter relative to a year ago. So even though this would be down quarter over quarter, it is up year over year if you looked at Q2 from 2022.
Yep. So basically, we talked a lot about my opinions on Airbnb, why I don't hold it. I would say my Asia trip has not strengthened my bull case, but probably strengthened my bear case. And a lot of the complaints that I'm seeing around Airbnb recently is like, and this has been my own experience as well, is a lot of the times when you use Airbnb, you're charged a lot of cleaning fees. And then before you leave the building, you get instructions like, okay, you got to take the sheets off the bed. You got to like throw the towels in the wash. You got to sweep. You got to take out the trash. It's like, so I'm paying a $100 cleaning fee. And then I'm also cleaning up your place before I leave. Whereas I'm in a hotel right now. And yes, we did switch to some hotels because Airbnbs are just not the move out here, we've learned. And with a hotel, it's like our room is cleaned every single day. Everything is nice and spotless. The bed is made for us. We got new towels every day. Trash is taken out every single day, and it's about the same price. So it's like, we're not getting this crazy high cleaning fee on top of the price, and we don't have to clean the place ourselves. So I don't know. Out here, at least, it's been so much better, and it's consistently been a lot better to just book with hotels.
Yeah. I think just talking about hotels in general, I don't see Airbnb taking away hotels. I think they will coexist. It does seem like there's some growing pains out there in Asia. The good news is the CEO talked about this directly on the call. And as you mentioned before, they build product very quick. So both on the host side as well as the consumer side, what they're doing about this is they're giving more price discovery tools for the consumer. So when you're searching, you can see the full price after fees or before. That was one of the biggest complaints. Another interesting one was they are now, which they didn't before, letting hosts see what the total amount charged is for the guest, not just what the host is charging. So they believe that that's going to allow the host to price more competitively, knowing like what the overall fee is. I was actually a little bit surprised it didn't work like that to begin with.
Yeah, that's actually very surprising. That seems like a no-brainer to me to do. Like,
yeah,
why is that not a feature already?
Yep. So here's the two most exciting things I heard on the call. One, they have 9.6 billion in cash equivalents. I think it's around 7 or something billion in literal cash, and the rest are short-term market securities. The CFO did mention the term merger and acquisition, not from the perspective of, we have, deals in the pipeline, but someone asked about, are they going to return cash as dividends or things like that? And they said very clearly, they will continue buying back shares. There's still 500 million left on their 2 billion share repurchase program. However, they have no plans on paying a dividend at all or in the foreseeable future. They believe that they could return more value to shareholders by keeping that money on the sidelines to either invest back into their own business or to buy something. This also coincided, Daniel, with Brian kept saying this. In May, they're going to drop some, quote, big features. And they keep on talking about the future of travel and that there are so many more products and things for them to build. One thing they talked about was Airbnb friendly apartments. So landlords are actually starting to look for ways to better market their properties and rentals to Gen Z millennials, people that could rent out. And that population of people also really likes having autonomy with their place and renting out. So it's small right now, but there's already 175 apartment buildings across the United States, which they're going to plan to blow out of the water, where within your operating lease agreement with your landlord, there's a direct clause in there about how you're allowed to rent through Airbnb and stuff. And that'll actually be a marketing item for these living rental homes that people are going to rent out. I thought that was incredibly interesting. They're also getting more into experiences, and they haven't mentioned this yet, but my opinion is they might even get into real estate rentals and things like that, where like Airbnb, the company itself, is the host. That's just me putting on my tinfoil hat. But I really believe, even at the market cap now, this company is just beginning to get started. I will actually be open about what my shares were. So this is my stock and lock portfolio. This is not financial advice. Please don't copy my trades. This is when I was buying Airbnb. It's definitely ran a lot on me since then. I haven't bought it since it just went over 100, but this is a company that I see continuing to grow, execute, and innovate long term. I am as bullish as ever. I do think the stock has gotten, not as cheap as it was before, so I'm not excited to be buying it at like 140. But to say I'm done building my position is likely wrong. I am just trying to be patient, though, because the stock's probably ran on me like 50% since I bought it, even more on some of these.
Yeah, I love that you buy literally like 1 to 5 shares at a time.
Dude, dollar cost averaging. I got zero commission, so.
Yeah, you're like the definition of dollar cost average right there. That's so funny. Like, I'm gonna buy 1 share, right? I mean, it's funny. I don't know how to say this. Like, I respect it. Like, I'm not judging you. I'm not making fun of you. It's just like, dang, that's like funny but sick.
Yeah, well, I mean, most of my, let's see. So if we look at what I've been buying, yeah, it's also, please do not follow these trades. This is not financial advice. That would be very foolish of you to do. But yeah, you can see very rare for me to buy heavy. I usually just do a few at a time. Some Google, some Indie, all that
We
stuff.
have a comment here from Eugene. He says, I like Airbnb, but hotels have rewards and loyalty programs with banks and credit cards, plus no maintenance. However, Airbnb is great for experiences in remote or unique places. And yeah, I would agree. Basically, what I think is like, I think there's a market for both, and they're probably going to overlap quite a bit like they currently are. But yeah, like if you want a really cool place in a really cool location and like a unique experience, then you have to go to Airbnb essentially. Like, you are not going to find that at a hotel. So yeah, I agree. I think there's definitely a market for Airbnb that's not going to go away.
Yeah, I'm going to love to flash back to this video in 4 or 5 years, because my prediction is they are just getting started in the travel space and living. So we'll see what they build. But yeah, great report. Super happy about it. Not super pleased about the stock running so much, but it is what it is. The next earnings report, I think we want to talk about Equitable Bank. So
this is
trade costs must be adding up. Trade costs are not adding up. I have commission-free trades, so I would not be trading that frequently if I was spending per trade.
Okay, I'm going to share my screen, entire screen. Sure. Okay, I'm sharing my screen now. So I took a few screenshots from Equitable Bank. I have a little bit of a different scenario in my investment where I thought the numbers were great and the stock does not like to go up, but which is fine because I like to just buy more.
Dude, it's because it's a bank stock.
Exactly. People don't like them, and that's fine.
Anyway, banks just don't get me excited. But get me excited about this bank, Daniel. I like the pink already. So
yeah. So their deposits are up 14% year over year. So people are continuing to bank more and more with this bank. Customers are up 23% year over year. Very good. And they expect deposit growth to continue growing at 20 to 30% in 2023. So basically, they're taking a lot more of the market share in Canada. And a lot of Canadians are moving over to this bank. And like, even people that I talk to in my circles are now moving to this bank because their services are just like far better than what you traditionally get at the larger banks. Anyways, so here's their 2022 guidance. And I always like to take a look at what the company guided versus like what they actually did, what they actually hit, how they performed. So they got their return on equity. They hit their guidance, 15.7% above their guidance. Their pre-provision tax income, they projected 12%. It's up nearly 20%. Adjusted diluted earnings per share growth, 9.4%. So basically almost 10% earnings per share growth, right near the high end of their guidance. Dividend growth, 64% if you want to round up. So they are massively increasing their dividend right now. And every single quarter until 2027, they're projecting to increase their dividend by 6% every quarter, which is 25% per year for the next 5 years. So yeah, they're significantly increasing their dividend right now, and this is like one of the main reasons why I bought the stock, because on the share price that I was building my position at, by 2027, if they hit those projections, then I'm going to be getting an 8 to 10% dividend yield on cost of the shares that I bought just a few months ago, which is really good. It's a really nice dividend. Book value per share growth, 13.4% beat estimates. And then their CET1 ratio, that's a bank specific ratio, beat estimates. So they're just crushing estimates. If you take a look here, this is their diluted earnings per share since their IPO to present day. Earnings per share in 2004 was 65 cents. This year it was $9.17. So earnings per share is up, that's like 15x over the past 17 years. So very, very, very strong growth to this bank. They're consistently killing it, and I love to see it.
That was a nice graph right there, up and to the right.
Yep, exactly. And then the last screenshot that I have here, just to make it a little bit quicker, their 2023 guidance. They're expecting return on equity again of 15%, pre-provision, pre-tax income growth of about 30% in the middle, EPS growth of about 12.5% in the middle, dividend growth at 20 to 25%, which they're projecting. Ridiculous. Book value per share growth, another like 13, 14%, and then the CET1 ratio high. So this stock is basically just projecting that they're going to have another incredible year. And, like these aren't numbers like their EPS isn't growing by 30, 50, 40% or anything like that. Like nothing absolutely crazy, but it's nice and it's consistent. And that's what this bank does. They just, hey, we're going to do another 10% book value growth this year. We're going to do another 10% earnings per share growth this year. And then they do it and they just keep doing it. Now, why I also love this stock is because if we head over to stock on a lock.
Yeah, that's a good insight score off the bat.
Yeah. So I'll just show you. Sorry, everyone, when I live stream, the internet is not the best. But what we can see here, if we go back to 2012, so the stock right now is trading for a price to earnings ratio of about 8.5, which if you take this, let's just take out their historical price to earnings ratio out of the equation for a minute. And let's just say, all right, this company is projected to grow their dividend by 25% next year, earnings by 13%, book value by 14%. Now, when I see those growth metrics, and then I also see an 8 price to earnings ratio, I'm like, what? Like, that seems a little bit low.
Isn't that normal for banks, though? Like, I thought banks' PEs were typically around like 10, 15.
The average Canadian bank sells for 11 to 12. But the thing is like, yeah, you can compare it to the sector and be like, yeah, it's still cheap. But the thing is also is the typical Canadian bank grows their earnings at 4 to 6% per year. So you're getting double the earnings growth, like triple the dividend growth for about what would that be, like 25% cheaper.
Well, is this bank like smaller than the other banks in terms of their overall numbers? Because sometimes you could have a smaller company and the percentages are bigger because they're starting from the smaller base, but then once they get to the larger size, does that apply for EQB?
Yeah, so the reason I think this stock is cheap, in my opinion, it's cheap, not financial advice, but why I think it's cheap is one, because it is a smaller company. And like, I know that up here in Canada, it's just almost like a no-brainer that our Canadian banks are so solid that they're just great investments. So like everyone just buys Canadian banks essentially. Like they're like the centerpiece of a lot of Canadian portfolios. That immediately creates a premium. So the fact that EQ Bank is smaller, it's gonna trade at a discount. It's not gonna have as much demand for the stock. And also, they don't pay out a lot of their earnings as a dividend. So their dividend yield right now is about 2%. The other banks are about 4 to 5%. So a lot of people buy banks for the dividend yield. And if you take a look at Equitable Bank, you're not getting that significant dividend yield because the company keeps a lot of the earnings inside so that it can continue investing in more growth. It's like it's a growth stock, but also a bank stock. So yeah, I think people look at it, they don't see a high dividend, and they're like, yeah, no dividend on a bank, probably not going to keep it.
That makes sense. All right. I got a fun question for you. So just so people are aware, obviously Daniel is a shareholder in EQB. I am not.
Yes.
The way I invest in any business is you look at the business, look at the product, look at the company, what it's building, right? So banks are just weird for me because a bank is kind of like a bank, right? Like you can have like a better mobile banking app, or like maybe you have a slightly different interest rate, but in terms of like having a quote moat, like they're similar to other banks. Also, I guess there's a moat and that is hard to like get a charter, right? So like I get that like not anyone could just build a bank. Just walk me through like as a shareholder when you get excited about these businesses. Like I hear you saying they're growing their earnings, they're growing all this stuff. What does that actually mean? Stupid question in terms of like what the consumers are doing and how they're getting that. Is this more people depositing their money into the bank? Is this the bank giving out more loans and then most of their like revenue comes from the interest payments? Because I guess that you'd have to value this business based on how good is their customer service and customer retention, as well as just trust in the Canadian government and things like that. However, of course, if that were to go wrong, I think the last thing you'd be worried about is getting your little paper fiat money from the bank. But I'm curious like how you think about this, because it's hard for me to get excited about or like see the moats or like really just visualize the growth story here. Or maybe it's just a return to shareholders type stock.
Yeah. So basically in Canada, there's like the big four banks, they call them. And it's like TD, BMO, Bank of Nova Scotia, and then Royal Bank of Canada. And those banks, like, they're just so freaking archaic. They are not entering the modern age at all, it seems. Like, I use TD Bank to invest, and their platforms are just like kind of trash. So Equitable Bank has been built. They're built on the cloud, essentially. So they can innovate super quickly, and they don't charge all these stupid banking fees and everything. And their entire marketing scheme is like, we are actually a bank that's for the people, and you are going to be able to keep your money here. Like, we're not going to charge you all these little fees. Like, there's no ATM fees, no e-transfer fees, nothing like that. And I don't know. It seems to be working. They're getting a lot of customers.
What cloud are they built on top of? Because that's the thing that stuck out to me. I'm like, well, own the infrastructure, right? Like, is that Amazon, Google? Who is it?
I don't think if they have disclosed it, I haven't seen it, so I'm not sure.
Interesting. Well, I'm glad that's doing well for you. I mean, did the stock move up on the earnings report? I missed that.
Not really. I think it was up like 3%.
Airbnb.
I mean, if you want to start comparing stocks based on what they do after earnings reports, then I think you're at the wrong channel.
I thought that we only measured stocks from their all-time high and all-time low, and that was the risk profile.
Yeah, if a stock's down 80%, then it's going to be a 5x one day, guaranteed.
Also, Burton is saying it's Microsoft Azure. I'm assuming that's for EQB Bank.
Actually, that does sound familiar. Now that I read that, I do remember seeing that somewhere. Thank you, Burton.
Awesome. So in some past shows, we've been asked a lot, how do we look into earnings? What are some of the steps we do? Daniel and I thought that it would be pretty fun to actually do that live with you. So one earnings report we have not looked at all yet is Disney. Daniel, I think it would make sense if you want to lead, or let me know if you want me to, for a screen share, and we can hit their investor relations website, but figure we could do a collaborative, just a little dive on their earnings, and then of course head into stock talk. But these are things that get me excited. Like when I, finish up all my coding on Stock Unlock and stuff, I look forward to sitting down and reading through a nice SEC report. I know that might sound crazy, but it does make me extremely excited.
Disney Princess, let's go.
Yeah. All right. We do have a good, I know we're jumping around. We do actually have a good comment that just came in from David on EQB. I don't know if we want to hop back quick to that and then hop into Disney, but one from David here.
Oh, I clicked it at the same time. Sorry. Okay. The reason EQB is cheap is because much of their performance is exposed to the housing market. In the economy where the Fed is raising interest rates, what do high interest rates do to housing markets? Well, as interest rates increase, housing prices naturally should come down. It's the same with basically every asset, actually. If interest rates go up, asset value should go down. Yeah, I mean, that's a risk. You got to think about that. Equitable Bank has historically had the lowest net charge-off rate of their loans out of any bank in Canada by far, and their net charge-off rate is still the lowest in Canada by far. So their loans don't seem to be going bad. Also, the loans in the Canadian housing market that seem to be a problem are on the higher end, homes that are above $1 million. up above 1.5 million. It seems like those are the loans that are starting to go bad, but the average Canadian or the average income Canadian is doing fine right now. Like homes are doing fine, people are doing fine. We have like the lowest unemployment in Canada in like something like 60 or 70 years, if not all time. So our economy is pretty hot. People are employed. I don't think loans are a problem personally. And Equitable Bank is not exposed to the area of the housing industry or the housing economy where I am most concerned. So for me, I'm not too concerned about this at all.
Interesting. Thank you for that comment, David. I mean, coming from someone who's like in between the bull and bear on these, like that's one of my things for banks. Like I'll try to start understanding them and I'll see comments like that. And it just makes me take that step back, be like, yeah, there's like just so much of a bigger picture here that I might, don't feel like I'm the bank expert enough to know. But yeah, super interesting points, Daniel. I'm glad to hear that things are going well up there in Canada in terms of the economy and employment rate.
Yeah, our economy's hot, man. It's pretty freaking hot.
Hot economy in a cold place.
That's right. Okay, so we were going to go through their SEC filing. So the first thing that I do whenever I'm taking a look at any new business is I basically just do what I just did. I search up Disney investor relations. So if it was like Airbnb, I would do Airbnb investor relations in Google. And then that should pretty much always bring you to the company's investor relations page. And this is where you can actually get the source of information. So right here, for example, we have the annual report from Disney right here. It looks like they have their fiscal year, their Q1 report. That's the most recent report. I like to take a look at the most recent reports. So companies also do this, like not Airbnb, Disney, for example. They're talking about their first quarter earnings for fiscal 2023, but you can see this is earnings for its first quarter ended December 31st. So their first quarter actually ends on December 31st. So typically when companies are reporting their Q4, this is Disney's Q1. So some companies like to do that. Anyways, also, I think we should give a disclaimer right now that Jake and I have not looked at this report at all. This is fresh, and we're just going to be going through this.
I am coming in here with one or two things already known. One is Bob Iger, the CEO, came back. So this stock has been in the news a lot. Obviously, Disney is a big company, but there has been a lot of executive shifting happening there. He left, he came back. There was drama with the CEO that replaced him. Obviously, they have their amusement park business, Disney Plus, all that stuff. And Daniel, one thing I'd be curious to uncover with you while we go through this is, this might shock you. I kind of put Disney and Apple in similar buckets, not to compare them too much, but these are two huge behemoth businesses that have existed for decades. I don't own them as an investor, and I've always had one eyebrow raised where great businesses, great brand, great product offering, but how much growth is left in these, and like what is there for shareholders when the company's already get this large? That's one thing I've never understood.
Yeah, it's interesting too, because like Disney, I think they started going down the Disney Plus route to try and like get another huge growth driver. And in my opinion, it's like created no shareholder value at all. If anything, it's actually destroyed shareholder value. So yeah, I mean, if they take away Disney Plus, then I agree with you. I don't know where the growth is going to come from. But we can see right here, the revenue for the fourth quarter, I'm just going to call it the fourth quarter, was 8%. Diluted earnings per share increased to 70 cents from 63. So that's about 10% growth. Let's take a look. Revenues up. Total operating segment. So their operating income is down. Net income was up though. Cash used in continuing operations. So it looks like the company, free cash flow negative. So their operating cash flow is negative. That's a negative 974 million. Last year, it was 209 million. So their losses are increasing and massively. They had free cash outflow of 2.1 billion versus 1.2 last year, almost doubled. So when I see this right here in an earnings report, where you can see the net income is up, but the company is losing money, and its operating income is 3 billion, but its operating cash flow is negative $1 billion. That's a $4 billion difference in these numbers right here. I focus on this one. the cash flow from this business is going out. It's losing money. Even though its operating income and net income are positive, this company is losing money. So these are the numbers right here I care about.
Interesting.
And yeah. So, and also taking a look at these numbers, I'm going to guess this was some sort of asset value gain that they reported as net income or something like that. So, income from operations, corporate expenses, amortization of those.
Yeah.
Fair
So
value.
so as we're going through this, Daniel, I did discover something as well, and I came back to our chat, and it looks like Burton says something similar. So I'll just read this. Uh, Rob DeSantis has arrested Disney in Florida, and then also drop dividend may reinstate. So I saw on their earnings presentation that they were talking about optimistic about our ability to declare a dividend by the end of calendar year 2023. This is slide 12 in their earnings presentation document. Then I went to Stock Unlock, and I saw this company actually used to pay a dividend and they stopped it. So something's not adding up here, Daniel. They have negative operating cash flow, but they're also talking about how they're optimistic that a dividend payment to shareholders will return by the end of this year. That is interesting to me because dividends come from cash flows and their cash flows are negative. And this is also a company trying to bring back a dividend. We know that people buy stocks for the dividend. A little bit of a red flag to me. Maybe I don't want to jump to conclusions here, but it's not adding up.
Yeah. That's weird. It's weird to me that they would want to bring back a dividend when they lost $2 billion last year. That means they're going to have to figure something out and get their profits back. What I'm also noticing right here is this is the paid subscribers of Disney Plus. Quarter over quarter, it looks like, and it was essentially flat in Canada, grew 2% internationally, 1% core. Total Disney Plus actually dropped by 1%. So basically, Disney Plus is not really growing anymore from what it looks like.
And that also killed their operating margins, if I remember correctly, right? Like, I think we looked at their reports like 1 or 2 quarters ago, and you could like look in the graph as to like when they launched Disney Plus, because like the spend to get that up was wild. So that's not good to see that that's stopping growth. Like,
yeah, and check this out. The average monthly revenue per paid subscriber of Disney Plus decreased from $610 to $595. So their average revenue per subscriber is now going down, which tells me they're probably trying to lower prices to get people in because Disney Plus is not growing anymore.
This is one of my big issues with the streaming companies as well. And I know you and I are both not fans of Netflix, but anyone with a lot of money can come in and make content. It is something that is getting really crowded and seems like it might be a race to the bottom in terms of margins, since it seems that the cost to produce content is going down and down. The options for consumers are going up and up. Supply demand side economics will tell you that that is not going to result in a lot of pricing power unless if, you know, people can really make truly unique shows that you can't get anywhere else. Arguably, Disney does have that with their brand. So it's a little bit surprising to me to see that they topped off here, and something to keep an eye out for sure in future earnings reports. If that stays flat, that's horrific for their business, the Disney Plus subscribers.
Yeah, I agree. And let's continue looking here. So this is their revenue. Overall revenue grew by about that 8%, I believe they said. Costs and expenses, though, you can see they increased by about almost $2 billion. So revenue increased by nearly $2 billion. Costs and expenses increased by $2 billion. So I imagine the company's margins are probably staying somewhat flat, but like, think about this. You generate $23.5 billion in revenue, and you have to spend $21.5 billion to generate that revenue. So you're immediately losing almost all of your revenue, and you have essentially almost no profit. It's a very low margin business. Interest expense on debt. After all these expenses, their operating income was $1.7 billion. Okay. Interesting. Now, net income from continuing operations, loss from discounted operations. So I don't know if I really want to read through like this entire report, but I want to go check out the cash flow statement. So yeah, let's take a look here. So the cash flow statement always starts with the net income. So we can see this was the company's net income reported. That's the top line of the cash flow statement, because what the cash flow statement does, it starts with the net income, then it adds and subtracts everything that was a non-cash expense or a non-cash gain that was reported in net income. So the cash flow statement is meant to show you like the actual cash flow of the business, like how much cash is it actually making without all these non-cash additions. And in my opinion, sometimes accounting magic. So net income, depreciation, cool. Equity-based compensation. So stock-based compensation was 558 million for the year as well. 507 million last year. It looks like, or no, 270 million. Sorry. Changes in operating assets and liabilities. Okay, receivables, inventories, accounts payables. Okay. So yeah, these are changes in assets and liability values, and it's being subtracted. So they reported gains on receivables, inventories, other assets, and accounts payables. And when you subtract all those gains, the company actually lost $974 million. Then they spent 1.2 billion on investments in parks, resorts, and property, which means the free cash flow was that negative 2.1 billion number. And then what is going on here? Commercial paper borrowings, $800 million of debt. They paid off $1 billion in debt. So they lost money. So if you go back to their balance sheet, their cash position should be dropping, and it is. So yeah, I mean, that's what's happening, right? This company is currently losing money.
Airbnb has more cash than them.
Yeah. Yeah.
That's wild.
Yeah. So, I mean, that's what's currently happening. The business is currently losing money. So maybe next year, I don't know if they're going to switch something around and next year it's going to be generating money. They could pay a dividend right now. They have, $8 billion of cash. They could spend like $2 billion and pay a dividend if they wanted to. But as of the business right now, it would be coming from this cash position. It would not be coming from the company's cash flow. So maybe that's also why they brought back the CEO, because they were like, we got to get this business back to what it was.
Oh yeah.
Like it has to get profitable again.
Yeah, the business has definitely been going downhill. And just for people tuning in, Daniel and I have not looked at Disney earnings yet. It would take a lot more time than just the 10 or 15 minutes in this video to fully go through them. So these are just some of the things we start to look at. Just to round this off, Daniel, I did just want to show people one more link quick, just so people can start self-serve and doing this on their own. Daniel is just going through, I think, the actual earnings report. Another thing that you can look at, which is nice, is the company's earnings presentation. So I'm not going to run through all these slides. There's a lot there. But one of the interesting things we talked about was the actual numbers coming in from their subscribers. So I just want to let you all know, whenever you're taking a really deep dive at a business, they will give you the numbers on their different subscription businesses if you wanted to take a deeper look. So, again, not going to walk through all these here. They go through their parks and experiences, but definitely highly recommend anyone who is a shareholder or looking to buy this that you go through these links and just gain a really understanding of where this cash is coming from, what they're going to do with it. This is an interesting stock for me, Daniel. I mean, not financial advice. I think I love Disney's brand. I would be a consumer for some of their stuff, but looking at their stock today, I'm not impressed. I would not touch it looking at some of the other opportunities on the market. Maybe that'll be a miss in the future, but I'm not.
Yeah, I would definitely agree with that. I'm actually going to, there are some charts I want to bring up and stuff, but in the meantime, can we just answer some questions while I get these charts up?
Yeah, we got some stock suggestions from the chat. Someone has a question. So we always like to be upfront about what we feel comfortable talking about and what we don't. What's your take on lithium producing companies like LAC or ALB? Correct me if I'm wrong here, Daniel. We do not have opinions on these companies today. I am personally not an expert on lithium, so just want to be upfront there.
Yeah, I think that this would fall into commodities for me, and I've been pretty consistent on Stock and Lock to basically say, like, I don't know what commodities are going to do. I think they're kind of speculative a bit. I could be totally wrong, but like I just have no idea what commodities are going to do. So personally, since I don't know what the company is going to look like in 5 to 10 years or what commodity prices are going to look like next year, even, I tend to just stay away from them.
Yeah, there could be opportunity for people willing to take the time to look into that stuff, supply demand side economics of who's going to be using this lithium, where's the amount at in the world today. And, like there are people who can get smart with that stuff. It takes a lot of time. We just haven't done it. A few more comments here. It seems like people are generally agreeing with our opinion on Disney. From David, hard for me to see Disney as a compounder. We agree. There's not too much, as we like to say, meat on the bone for this one. I said that about Tesla stock once and people got frustrated, but it's just my opinion. Disney is not my stock, says Lars. They burn a lot of cash. And
I'll show you. I'm going to show you the chart now. So
cool.
When you take a look at this chart, do you want to take a guess at where Disney started investing in Disney Plus?
Is it off the chart? Is it behind the page, actually? Are you on the right one? Obviously, right there, looks like something happened to their business. What is this? Operating cash flow. Okay, so...
Yeah, so operating cash flow, like you can see, Disney's business apparently was growing incredibly well for like over a decade. And then right here, they were like, let's get into streaming.
Well, okay, wait, hold on. A little bit of a rebuttal here. I'm not confident on this, but correct me if I'm wrong. That's also when COVID started, and this is operating cash flow, the money they bring in. They had to shut down all their parks. So
this is not COVID.
That's not COVID? What is it?
This is 2018.
Oh, 2018. Okay. Yeah, so that's not right. I was going to say they definitely lost revenue from COVID coming in. I'd be interested to see their margin, actually, because their operating margin is what would have been destroyed, right?
You can see right here, the revenue is actually at an all-time high, apparently. But if you take a look at the revenue plus the operating cash flow, we can also take a look at operating income. But like these two things are moving in the opposite direction now. So let's take a look at operating income quick.
Can we bring out their operating margin?
Yeah. So operating income is also significantly down. Let's take a look at their operating margin.
Yeah.
And this is what I mean. Like
that's it. Yeah.
This is like when they started investing in Disney Plus, and it's just burned so much cash, and now they have destroyed their margin. They're losing money now. And yeah, you can see why the old CEO from when the company was growing profits consistently is now back at the company. So like that could be a good thing. But it looks like they need that guy back because like the fundamentals of this business have totally changed. It is not the same business that it was in like 2015.
And also, like, not all businesses live forever, right? I mean, not to start a side conversation about the Dutch East India company. So Disney, great company, still a great company. Will they be a great company in 10, 20 years? Like, that does not seem solidified to me. Quick question here from Omer. What's your opinion about EQB earnings? Watch the recording of this on our channel after. Daniel went over those earlier in the stream. Sorry, back to you, Daniel.
I actually forget. It probably wasn't important. We have people asking us about stocks now, though.
Let's do it.
Okay. All right. Copart. Let's wrap up the stream with taking a look at some people's stocks.
Yeah, we always do our best to get through all of them. So if you have stock suggestions, we've seen a few come through. We'll try our best to get through all of them, and probably won't.
Okay, Copart.
I've never heard of this stock before.
Me either. Insight score 4.19 out of 5, $32 billion company. Pretty massive company. Really started running in 2016, though. Like, look at that run since 2016. It's up 600%.
What do
Does
they...
look like it is kind of expensive right now. Let's take a look at what they do. Copart engages in the provision of online auctions and vehicle remarketing services. The company is headquartered in Dallas, Texas, 9,500 employees. The firm provides vehicle sellers with a range of services to process and sell vehicles. I see. Okay. So they're basically involved in the automotive industry and help people sell their vehicles. Interesting. I've never even thought about this industry before.
Well, so I just started thinking of Carvana, which is slightly different. Like Carvana is obviously run by the fraudster and is tanking or maybe going bankrupt, but seems like this company's a little bit different, though.
Yeah. So also, I was reading that used car prices and car prices in general like went crazy during COVID, because there was a significant supply problem, and there was also an increase of demand. So basically, supply was down, demand was up, so car prices went insane. And you can see right here that right around COVID, like the company was growing revenue, but then right here, like revenue was kind of flat. And then when car prices started going crazy, like their revenue started freaking exploding. And now it's like up all the way up here. The revenue has been growing for a year, like a decade though, so that's nice to see. But I just would want to know, based on like the 30 seconds that I've had to understand this business, one thing that I would want to know is like, is this sustainable? Like, what happens if car prices come back down now that like supply chains and everything are being fixed? Is this going to be sustainable? And if not, then what does the business look like when revenue starts coming down? If it starts coming down.
Yeah, I'm on the insider tab too, just to see if there's like people selling. There are like some sells from mid 2022, but not really too much here. More from like independent directors. It looks like the CEO made a sale back in September of 2021, when the stock was at 147 a share, or that's what it claims on the buy price. But yeah, it doesn't look like the stock ever touched that, so I'd have to take a deeper look there.
Yeah, that's like the thing that I would think about. And then here's the other thing for me is like, this company is currently trading. So immediately, I don't know if I am fully confident in the future of this business, at least like over the next few years or like the next 5 years. Then it also has a price to free cash flow of 43 and a free cash flow yield of 2.3%. This is a pretty low yield. So like, I think that there's probably some significant risks to at least consider. I don't know if I'm right there, but there's some risks that I think people should consider. And then also, you're not really being compensated at all for that risk with a 2.3% free cash flow yield. You're actually not being compensated basically at all for it. So I don't think that it's the best looking stock from my 1 minute analysis, at least. And I could be totally wrong, but that's my raw opinion.
Yeah. I agree with you here. Obviously, you have not looked at it that much, but I just don't see a lot of meat on the bone here. Like normally, you buy stocks for growth. You think that they're going to continue to 2x, 3x, 4x numbers. Their multiples then come down relative to what you bought it at, and I'm just not seeing that story here. If people are confident that their revenue will grow, they have more ways to make money in the future and to continue to innovate in their space, like maybe, but not excited about it.
Yeah, I just don't know. I just have no idea.
You want to pick the next one here?
Yeah, so I made a video on SDGR. This company is called Schrodinger. Bill Gates, I think, invested like $500 million into this company. He bought like over 10% of the company. So I made a video on it. And I have not actually taken a look at it since that video. So what is even the ticker for Schrodinger? What is it?
SDGR.
Okay. Am I sharing my screen, Jake?
No.
I'm not. Okay. I'm going to share my screen. We can take a look at this one quick. Okay, Schrodinger. So it's all the way down to 2380.
Do you know where Bill Gates bought it at?
I think he was buying in like the 60s. So he's down quite a bit.
Interesting.
So this company, it's also a really hard company to understand. Like they basically use technology to like try and figure out what medicines are going to work or not work before they invest the money and time into like actually developing new medicine. That is based on the information I read about this company over a year ago. It's locked deep in my brain. So if I'm wrong about that, I'm sorry. But it's like a really high tech company that's like working on some pretty cutting edge stuff. So let's just take a look. at the financials, like how have they developed. So revenue looks like it's up, but not really that consistent. Well, actually, it is growing consistently, trailing 12 months, but quarterly looks like it's kind of bouncing around. Cost of revenue is doing that. Okay, gross profit. Let's just take a look at gross profit, TTM. Gross profit is growing too. Cool.
Yeah,
Here's the thing.
My Peter Lynch alarms are going off, where it's like, if you can't explain this business to a
I
5-year-old,
know.
you probably shouldn't own it.
Yeah, and also their R&D expenses are growing a lot. That's like the business's main expense is their R&D. So you can see they had a revenue of 170 million, spent 81 million on cost of revenue, gross profit of 88.6. Then they spent 230 million on operating expenses. That's paying their employees and paying for research and development, which means that this company is losing money.
Oh, wow. That operating loss is
Yeah.
straight down. We also have Vic Gill saying AI is going to kill SDGR's business model, and most
Yeah.
big pharma is in this space. So that is, I mean, that makes sense to
Yeah.
me.
So basically, what I did want to say, I agree with Vic here because Google, their, I think it's their DeepMind, they released something like this high tech stuff. I'm not good with it. Okay, so I'm sorry, but they released something that basically allows people or biopharmacists or what bio I don't know the words right now. All right, it's late for me. Um, I'm really struggling on this one, man. Anyways, Vic, I think you're right. I think that Google's DeepMind is going to make Schrodinger.
Did we just lose Daniel? Okay. Well, that's funny. Daniel is in Asia right now, and his Wi-Fi cuts in and out. So we will see if he comes back. I think he's coming back. I believe what he was saying was that there's a lot of technical jargon in here. They're spending more. Oh, you are back, dude. I was stranded and terrified, but
Yeah,
you're
I
here.
just disconnected.
At first, I thought I disconnected and I froze, and then I realized like I was the one that was actually still connected. Anyways, I think you were making your point pretty clear there.
Yeah, just to summarize everything, I think Schrodinger goes in my too hard pile. I'm just like, man, nah, I would not feel comfortable owning that stock.
It's all good. I'm gonna hop through a couple of these, and I think I'm gonna take Datadog. Zim is that shipping container company with the very high dividend yield, right? Because we've talked about this one a lot. If I am correct, and it is that company, there's just a lot of speculation around shipping costs and if those are gonna be maintainable. So
Yeah,
we'll not be.
we get
Sorry,
asked
Daniel.
about this. We get asked about the stock all the time because it has a very high dividend. Basically, to summarize, it made a lot of money when shipping costs were going crazy. We don't know if shipping costs are going to stay high. If they don't, what does the company's profitability look like? We don't know. Is the dividend going to remain high? We don't know. So a lot of questions we don't know. And I just like I don't feel comfortable or confident that the dividend is going to remain for the long term.
Yeah, I'm actually going to get our Discord link. If anyone is not in our Discord, it's like totally free. And there's just a lot of really awesome conversations happening in there. You could also search some of
Yeah.
our rooms where we have had a lot of great threads about ZIM specifically. So, obviously no pressure, but just drop that link in there. And
Yeah,
Daniel, I
I
think,
believe we talked about Zim in there quite a bit too.
oh, yeah. Sweet. We got a couple minutes left. I'm actually going to do Datadog. As an engineer, I get excited about this company. So, Daniel, feel free to ask me questions while I'm sharing my screen. And Oswin, thank you so much for this suggestion.
Wait, Jake, are you an engineer?
Someone made fun of me for that once. They're like, "Oh yeah, Jake, like we get it," and I'm like, "All right, like if you're insulted, like that's on you." So Datadog, just to go down to give everyone a little bit about what this company does. This is a $25 billion company. Not that we like to measure things from the peak, but obviously down from where it flew during COVID. You can see it has a pretty low free cash flow margin, but at least it's there, which means that it is making some kind of money. So multiples off the bat look a little bit high. Scrolling down just to give everyone a little bit of a better idea, they engage in the development of a monitoring and analytics platform for developers, yada, yada, yada. So basically, they're a business-to-business company. A lot of companies have a lot of data aggregation and analysis needs, of course, and in-housing those services is incredibly expensive and takes a lot of teams to do. So in the fragmented digital service economy that we have, Datadog is a big player in that space where they have lots of big contracts with more non-technical
Yeah,
companies,
so Jake,
or what's up?
the one thing that I saw about this company was that their growth is starting to really decelerate. And
Cool.
then I know people who owned this stock and sold their entire positions because Datadog's growth is starting to decelerate quite significantly, and they believe that the market's gonna, price it a lot lower now that its growth is slowing down.
Yeah, let's take a look at that because Stock and Lock says that the growth is a 5 out of 5, which
Can
is
you go take a
looking at
look at
the
the
trailing 12 months.
yeah, take a look at the financials and see if the revenue's been consistently going up or what.
Okay, so operating cash flow is down relative to its highs. So these last 2 quarters weren't the same. Is up year over year. Okay, Daniel, my high revenue, low profitability senses are tingling because we're seeing the top half of the income statement go up, but that also includes their expenses. So
Yeah,
this company is losing money. I'd be interesting to see where they're getting their cash from. So maybe we could check out their debt and diluted shares. Okay, they're
I
not
think
really diluting.
I think they're probably doing stock-based compensation, which is why operating income is down, but operating cash flow is going up.
Wonder. Ooh, well, okay. So this company has $738 million of debt. It's interesting.
How much cash do they have?
They have 1.7 billion in cash, so their cash can cover the debt, which is nice. But also they're not making money.
Well, their cash flow is positive.
Have a high gross margin. Yeah, let's check out their free cash flow. Okay, so yeah, there's obviously two sides of a business usually, like what are their financials and what is the actual business doing. I'd say just on a financial basis relative to what it's trading at today, it looks like it's on the pricey side. So then, of course, the second question is, well, do we think that this company is going to continue to produce more cash flows in the future? Where if you bought it today, are you buying it at a discount relative to what you think that they will be making? Analysts seem to think that the revenue and earnings will keep going up. So analysts seem pretty bullish. There's actually no sells in here. Daniel, you and I very famously do not like to trust analysts. It's also good to see what the insiders are potentially doing here. Okay, this is very interesting to me. So what
That's a
we're
lot
looking
of
at here is,
sales.
yeah, the
And those are big
insiders,
sales.
they're doing a lot of selling.
And okay, one thing that I don't like to see is like big sells and then big sells when the stock is down. Because that's like,
Co-founder, CTO, director, CEO, co-founder. So
yeah, and
the
those are like
co-founders and executives.
those are $6 million sells right there. Like those are not, insignificant sells in my opinion.
Yeah, I don't like a one size fits all thing, but things are starting to compound for me here. Their financial performance is decent, but it's trading at a premium relative to its financial performance, in my opinion. The literal co-founders who started this business are making massive, massive sales of their shares. And just
But
from the tech side of things, I know that while they do have some stickiness in terms of their revenue, I think that these data processing products do not have huge moats. I think I
Jake,
had this issue with Twilio as well. Not that they do data processing specifically, but I do question how big of a moat they have to grow for the rest of this decade.
okay, I'm going to share my screen really quick because we just saw Datadog. I want to show everyone one stock that I do like in this space that I was heavily considering buying. I never did, but I actually wrote a newsletter on this stock for Stock and Lock as well. This company is Fordnet, 14net, sorry, and it was selling off. It got all the way down here to about $45 a share, and this is when I was writing our newsletter on it, saying like I think that the stock is looking interesting, but like I personally would like it lower. It never happened. Now it's run back up. But this stock, I believe, is in kind of the same space as a lot of these like cybersecurity and companies like Datadog. Like they're a software business that's just growing super, super quickly. And the reason I liked this business is because you can see revenue is growing super well, like ridiculous revenue growth, which is what you see in companies like Datadog and everything. but their operating income is also growing. So this is like one of those software companies where it's like, wow, their revenue is
Wait,
growing, but so is their operating income.
Daniel, you're trying to tell me that a company is actually bringing cash in and profits from the services they're selling. Why is that
Yes.
so crazy? Like,
In the high growth software business, I guess there's just too much to ask for. But hey, Fortinet's doing it for their investors. And take a look at this. Operating cash flow has grown from 141 million a decade ago to over 1.7 billion now, so more than 10x.
so why didn't you buy it? Was it a valuation thing? Was it
Yeah.
insider activity? What happened?
Let me go over to our free form, and I'll show you what I was seeing. Let's go to risk premium. Over to Disney. So if you take a look at the risk premium, this metric basically compares like, okay, what is this stock offering versus a bond, which is the risk-free rate. And like right here, it was around 1. And this is like when I was writing the newsletter, when I was really considering it. In hindsight, yeah, a 1 risk premium is probably like solid. But I wanted a little bit more of a premium for taking a risk on this stock, is basically what it was. And I did not quite get that. And now you can see that the risk premium is now below 1. So now Fortinet is not offering what a bond would offer. So basically, based on everything Warren Buffett and all those guys teach, this stock is not selling for a margin of safety, and it is on the more risky end right now.
And
So the valuation just has to come down more for me, basically.
I say that this is one of my favorite spicy questions. Just because we like to keep things interesting here. You said that this is a cybersecurity company, correct?
I'm gonna say yes. Yeah, I believe it is.
Yeah. So at least for me, like for buying any business, I want to be able to like explain it to a 5-year-old. So I would even put this one in the bucket of it is really hard to be an expert on like the B2B cybersecurity sales and like figuring out what companies have moats, what don't, as like technology advances so fast. Like, do they have an employee base that's going to keep up with the scale of innovation? Are there going to be other incumbents that come in? Will like Google or Amazon just create like a cloud service that's one plugin and done, and then most of these companies in this whole industry starts waning away in the next 5 or 10 years? Like, there's just so many unknowns for me that it really just has me looking elsewhere. That is one of my favorite questions to ask myself. Like, if I couldn't explain it to someone who was 5, do you feel like that you're in the position to do that with this company? I know you didn't end up buying it, but
No, and I would want to get in that position before I bought it. But I'm gonna answer a few questions rapid fire, and then I gotta get to
oh yeah,
bed.
dude, we gotta get you to bed.
Yeah, it's getting late. I'm drifting a bit. So
You want to pick an end time? I'm a pretty good time owner, so I can make sure that that you get your beauty sleep.
thank you. I'm just gonna rapid fire. So this is Stock Auto. Everyone, Stock Auto, great YouTuber. You should go and check out his channel if you have not seen it already. Thank you, Stock Auto, for tuning in. He says check Palo Alto out. You may like it as well. So everyone, if you like Datadog, if you like Fortinet, go and check out Palo Alto as well, and maybe add it to your watch list or research list. And then let's see.
Should we have
Stock
Stock
Auto.
Auto on a live stream? Someone said that he should do live stream, so maybe we can consider having guests in the future.
Maybe we should. Maybe we should reach out to Stock Auto and get Stock Auto on here one day.
What's up?
You will like it as well. It's cheaper than Fortinet, and they have similar services. So yeah, check out Palo Alto. SM Finance says, did you go over EQB earnings? Yes, we did. It was around 20 minutes in, I believe, somewhere around there if you want to go and check it out. I went over just like the highlights really quick. Nothing deep, but just basically gave my opinion. Vic Gill says Magnet Forensics is going private. I know, kind of sucks. I mean, I made 170% on the stock, but honestly, long term, I think I would have made more if the stock was not going private. It had all the aspects and ingredients of a long-term compounder, and yeah, I would rather take a long-term consistent winner that could potentially 10x over a 170% gain. I just think it's kind of sad. I don't know. It's what it is.
170%, and I'm sad.
Hey, I've lost money on other stocks too, so like it's They don't all play out, as I'm sure everyone knows.
I understand. I'm complaining about Airbnb running like 50% since I bought it
Yeah,
too. So
yeah.
I'm
Like
not
I'm
trying to
not.
be a hypocrite.
Yeah, we've had some bad picks too, so that one offsets it a little bit, which is
Yeah.
good.
Someone asked us if like any cannabis stocks you're watching right now, and I looked at that and like no.
Yeah, that took too
I
long.
probably lost a good like 15K. Sorry, not lost, unrealized. If I were to sell today, probably down like 15K on my cannabis positions from the last 2 years.
Yeah, that was a lot of learning. Stock Auto says happy to do it. Yeah, maybe we can get Stock Auto on a live stream here pretty in the near future.
You know where we are. Reach out to us.
Anyways, all right. I had someone ask about my last name as well. My last name is Dutch. Daniel Pronk, Dutch.
Oh yeah, someone made
You
a
know
comment like about your mom or something.
Yeah, my
Like,
mom's last name is Letaniami. She married my stepdad, who is German.
wait, do you know what a good investment is? ... Engagement. Vic, who is that geared at? Me, Daniel, both. Also, I wonder if that's a planted question. Anyways, we digress. This might be a great time to wrap up. This was Stock Talk number 21. We try to do this every week. Daniel is in Asia, so we do our best. Last week we missed, so please subscribe to Stock Unlock channel. Hop in our free Stock Unlock Discord, and if you have not made an account on stockunlock.com yet, not here to oversell, but we are the co-founders of that business, building investment education and analysis tools, basically ignored by everyone else, or they just charge too much. So free 14-day free trial. Check us out. Any last words, Daniel?
No, just thanks everyone so much for tuning in. And if you want to know when we're going to live stream again next, join the Discord. That seems to be the best place because we announce the live streams ahead of time. While currently I'm in Vietnam, 12 hours away from Jake. It's a 12-hour time difference. Like it's morning for him, night for me. I'm going to bed. He's waking up. So, we got to find times that work until I'm back home in Canada. So it's a little bit more unpredictable right now. So again, if you want to be informed when the live streams happen, join the Discord. Jake just put a link in the chat, and we'll notify you like 1 to 2 days ahead of time so that you can know when we're going to do it. And yeah, I think that's about it.
Thanks for watching, everyone. Who's going to hit the end broadcast button? Let's be very clear. Sometimes we both think we hit it, and then no one hits it.
I'll hit it, but Rob H just asked, when am I coming back? I got to let the people know, man. I'm coming back April 6th.
I'm just trying to get your ass to bed, dude. I mean, I'll hang out, but all right. Gonna hit the end broadcast button. Thank you, everyone, for joining. Enjoy your weekend.
All right.
Clicked. It's clicked. Okay, 2 clicks.